Joining us now, Kari Firestone, co-founder, chair emerita of Aureus Asset Management, as well as a CNBC contributor. Been kind of calm when you've been on recently. Is your calm being shaken at all at this point, or no? You see any troubling signs? Anything percolating up? Any canaries dying anywhere?
Well, there's always the possibility, and we've seen action in the market, particularly at the end of the weeks, that would be a little more concerning. But if we consider what's happened over the last 2.5 years, for sure, we have up 12% this year, and we've been up 25, 26% in the last 2 years. I think it's time, perhaps, for a correction. Corrections happen to markets. We forget about it because it seems so unlikely over the last several years. But if the market were to go down 5 to 10% with the valuations we have, I don't think that would be out of line, and it would be healthy for markets. I mean, markets need to have some resets, and this market has gone straight up. A week ago, we were just talking about, or 10 days ago, new high, new high, new high, new high. How many new highs have we had this year? So to have a little bit of a correction and show that there's some realistic behavior by markets would be a sensible thing, not an irrational thing.
There are pockets of troublesome speculation. And you off camera called it what, rolling?
I call it rolling bubbles. Rolling bubbles.
Which is better than roiling bubbles,
yeah,
I suppose.
Definitely.
Rolling bubbles can turn into roiling bubbles, probably.
Right. Well, they could. But remember, in 2021, we had meme stocks. You guys were talking about NFTs every day, talking about a roaring kitty all the time. I mean, forget about those. Now, they didn't have huge impacts on the market, but those were bubbles. AMC was 65. I mean, I love Adam Aron, a friend of mine, but stocks 2 and GameStop 120, and it's 20 or something like that. So you can see these stocks in the AI space that have been up on just enormous moves. You know, up 30% in
But AI is such a bigger part of the market.
phenomenon is the same, but it's got to be it's
the amount of
logarithmic, exponentially.
Okay, but
probably 10 to the third in the top.
If that's a bubble and it
how
pops,
much money
it's
we're
be
talking,
a lot more pain.
and just how much money we're talking about that's involved.
Correct. But the companies behind it, if you look at Google, Meta, Apple, Microsoft, these are the biggest companies in the world.
They're
biggest revenues, biggest profitability. They're bigger than industries. They're bigger than
And they have real
countries.
businesses,
They have
unlike
huge
some of the.
businesses.
I mean, AMC does too, but it's
But it's not like those companies are going to disappear or yank their funding entirely. But even if they were to say, hey, we're going to cut our spending, our CapEx spending by 10% next year on AI, that would probably have a pretty significant impact.
It would have an impact mostly on chips.
Right.
And remember, until 2025, everybody thought of chip stocks as cyclical.
Right.
They used to have cyclicality. It wasn't because they wanted the cyclicality. It was because the people who ordered from there, their customers, said, we're going to cut that order or postpone it or defer it. That's what the chip business was about. It was about the buyers saying, we don't need all those chips that we've ordered from you over the next, 10
So is that
years.
not going to happen anymore because there's so much demand for AI compute power?
I think it's likely to happen to some extent. We have no idea what these hundreds of billions of dollars of chip purchases are going to do. And if Google finds in 2 years that they're not getting any return from the investment, I think that they could scale it back, but that doesn't mean it's the end of chips. It means that there'll be a 20%, 30% correction in the stocks. We saw that last year with NVIDIA. The stock was down over 30%, and then it came back to an all-time high. This has been the case. When I say rolling, these bubbles or cuts or corrections come back very fast.
We were up 36% or whatever since the April lows.
Yeah.
But you are seeing things like, suddenly the 10 years, maybe it's because they're round numbers and we talk about them a lot. 10 years suddenly is under, 4%. Oil is firmly below 60 right now. Gold goes up every day and it's at an all-time high.
Yeah.
Bitcoin, these things, Bitcoin's not supposed to be correlated, but it is correlated with
Sure.
It makes sense that it's down, I guess, since it's a risk.
Well, it's a speculative asset.
A speculative asset, but all these other, do any of these things, do they portend something more than 10%, or in a market which really hasn't been embraced that much, I don't think. Maybe 10% would do it. I mean, people are already worried, already talking about bubbles.
Well, people are worried about any drop in valuations at all.
The weak hands might be selling right now, theoretically, or not.
Yeah, it feels to me as if the market is primed for something over the next few months that's going to be a decline.
And not 20.
I don't see the 20 because the earnings, GDP is good, interest rates are coming down, and also
right, interest rates.
Yeah, interest rates are coming down. And remember, we're in an environment where if you are big, like the biggest companies, they're able to help their own problems go away, because they can structure a deal, they can create something with the government, whether it's NVIDIA on the revenue from China sales. If it's Google, it's a fee, it's $2 billion, and you don't have as much problems with antitrust. There is an ability for the largest companies who, again, control this market and, in a way, control the economy to solve their problems that did not exist 5 years ago.
Someone yesterday was talking about the fiscal and monetary juice that's coming. A lot of it from the one big beautiful bill with corporations. It's not just extending the 21% lower tax rate on corporations from 2017. There's a list of things that corporations got
right.
in that bill in terms of 100% expensing and different tax rates, and none of these tax breaks have not hit yet. So there's going to be some fodder. For expansion and I guess it could make its way into the market. How much is in money markets right now?
A lot.
7 trillion?
Trillions, right. So the investment world understands that's coming. It's not just U.S. investors, it's foreign investors. They see that there are benefits for corporations of this company. And the public companies, as we know, the number of public companies has declined by 50% over the last few decades. And if you're a public company, it's a good place to be if you're going to have less regulations, because they have tons of regulations. That's why you're seeing more IPOs in part. IPOs, remember, they go from private to public. It used to be that private companies didn't want to go public because the whole idea of all of the filing and the rules. Now it's going to be less onerous. So I see that as a positive for public markets.
I mean, if there are things that we don't know about in the credit world that are, ready to rear their ugly head, isn't a declining interest rate environment, doesn't that take some of the stress off the things that could be, like as the tide comes down, no one's wearing a bathing suit? That's a Buffett quote, isn't it? Yeah. And if you've ever been to a new beach, everybody.
Well, tell us.
Everybody should. Well, no, everybody should wear a bathing suit. Everybody should wear a bathing suit.
Right. It's an ugly sight.
Don't you feel that if we have problems, and remember, we had First Republic disappear, Silicon Valley. Now, those were big. Those were a lot bigger than what we've seen right now. The market absorbed those. There was a way for the system to create a process by which those companies were, consumed by others. And that's within the financial mechanism of the United States. Now, I don't think it's impossible for a bank to fail, a regional bank. That's why these banks are going down to the extent that they are right now. There's fear. But I don't see that.
But you don't think those loose credit or situations extend to any of the bigger banks, the brokerages, anything along those lines? Because that's the question. Jamie Dimon brought up the question this week where there's one cockroach, there's a lot more. Yeah. And that's the fear. Is there more off-balance sheet stuff that we don't know about? Have the general lending conditions not been as strict as they should have been, given what we've seen?
Yes, they have not been as strict. They've not been as tight. And I would imagine that there will be more problems, particularly in the private credit side, where we really haven't seen anything materialize.
Off-balance sheet stuff?
Yeah, the off-balance sheet stuff. There's so many private credit funds that the public has embraced. So it's likely that there'll be a problem. Can we absorb that? Is that going to cause
it's not systemic. It's not going to. The whole system is not going to be shaken, or is it?
Well, it might be shaken a little bit, but there's a lot of resilience in our systems, and compared to what happened in 2008 and 2009, I don't see anything to that extent. But at this valuation, you have to worry and say we've got a high price level of many asset classes. And that's what is of some concern. But it's not a concern that I would say, wow, just stay away. I mean, we cut back on Google, Meta, Amazon, some of these names that we own lots of in our portfolios, but they got to weights in those portfolios that we felt it just prudent to cut back, but we didn't sell the positions.